Hey guys, this is Scott Horn with Goat Funding, and we're just talking a little bit about hard money lending for beginners. So you're getting ready to do a property, you got one under contract, you got to borrow the money to do it. What are the things you need to be thinking about and going through? So I hope you find the video helpful. If you do, please like it, make any comments, we'll get back with you on those. And please take a moment and join us on our YouTube channel. We'd appreciate you all doing that. So hard money, guys, is just a tool of the trade. That's all it is. Don't let the word hard fool you. It's just an interest rate. It's just an asset-based loan that doesn't require anything from you other than your ability and knowledge and ability to make monthly payments. Now, different hard money lenders approach deals differently. Some require different credit requirements. Some require down payments. They have different loan-to-value requirements, interest rates, points. Some play all types of games that they charge you a higher rate on your first 3, 5 deals, whatever it might be, lower rates on other ones, things of that nature. All types of games. In today's marketplace, what I see so much of is typically a mandatory 10% down payment of cost. So if you're buying a property for $200,000, they want a $20,000 down payment. And then they'll finance the rehab at 100%, so long as that the total loan does not exceed 70%, 65%, 75%, some number. But it's going to be a lower interest rate in that scenario because the house needs repairs. And there's always a chance that the house defaults and they get the house back, and they've got to instigate those repairs. So you need to know what the lender's requirements are that you're out making. And again, as I said, I see that it's so prevalent in the marketplace is that minimum 10% down payment where they're wanting more skin in the game. So does that mean you're getting a 70% loan to value, or are you getting a 60% loan to value? Well, do the math, look at your numbers, and know what it is you're getting with specificity. When you're approaching a lender, but besides knowing what their terms are, so you know exactly what you're to expect and anticipate, other than a down payment, it's what is the monthly interest rate? Is it interest only? Do they require taxes to be paid in escrow? What are their draw requirements for repairs? And really, what are they looking for from you? What do they want to see? What's the term of the loan? 6 months, 9 months, a year? What happens after that time and if that comes up? Do they call the loan due automatically? Are they going to renew and extend it? If they do, what are the costs and those fees? What should you be doing as the borrower along the way? So knowing the lender requirements, how they work with you is so important. Who comes out to do the inspection on a property for your draws? Do they send some appraiser out? Do you send in pictures and repair takes off and maybe invoices from your contractors that they then work off of and approve? Do they send a third-party inspector to look at it? It's across the board right now in the spectrum. It used to be in the Texas marketplace, each company had inspectors that would go out and do what we call stand on the dirt and look at the property. And that's really the best thing to do to protect the lender, because we have seen it all. Guys, I'll tell you, I gotta say this because I found this kind of funny, where a California lender had lent money in Texas, and in all the pictures it looked like granite countertops had been installed in the kitchen and bathrooms. So we're looking at buying this property, and I go and get access to the home and look at it, and there weren't granite countertops. They were plywood. It was a sticky paper that looked like granite laid down that the previous investor had sent pictures to the lender as if granite countertops had been installed in the kitchen, in the bar area, the bathrooms, etc. Probably got a $10,000 or so draw for that, and it wound up being tack paper. That's it. And I have just complete fraud is what that was. But that's what can happen with pictures if you're not there on the job site to look at it in real life and see it. And you can manipulate anything you want to manipulate in the way of invoices, etc. So don't take it wrong if somebody wants to go out and look at the property or send a home inspector by to look at it for verification purposes or validation. That's just common sense in the business. But guys, I'll tell you, when it's not your money and it's somebody else's money that they're lending and they don't have any liability, maybe they don't care. I get it. Maybe that's more power to you, but don't run that risk of defrauding somebody in those kind of regards either. So know what the lender's terms are, what their interest rates are, what the length of the loan's going to be, how renewals and extension may happen, what they expect from you along the way, whether it's 6 months, 9 months, a year, longer. Think through these kind of issues. Think about the fact that on repairs, they want to see these in good and workmanlike manner, meaning you can't go in and just put lipstick on a pig and say you did a $50,000 rehab when in reality you did 10. You got to do things the right way because you're looking for an exit strategy for not only yourself, but for your lender too. It is always smart in business, guys, to take care of your lenders. If you lose your lenders, you lose your business. If you mess around your banks, they're gone. And word travels fast from lender to lender. If you jack around your hard money lender, you get foreclosed on, whatever it might be. There are various lists that float around out in the marketplace of these kind of things. And you don't want to be on that list. You don't want someone to call in and get references somewhere and things happen. Does that happen? It certainly can happen. So if you are a beginner, know your project. So besides knowing lenders, and you can shop lenders and ask them basic questions, what the requirements are, what they look for, etc. So you can compare lender 1 to lender 2 to lender 3. Great, and I'll tell you for the most part, they're all about the same, except for that down payment requirement that's out there along the way. There are some that'll push the envelope to a little bit higher loan to values, and that's fine too. I will tell you though, in our industry, in our business, it's smart to stay at about that 70% range for a lot of reasons and not pushing that envelope up too high unless you've got the financial ability to carry that debt load and to handle that transaction in the event you're able to sell that home or refinance it for some reason down the road. But when you're going to go talk to your lender initially, have a plan of what you plan to do. Go in there armed, ready to answer their questions and to give them the information they need. Have a copy of your contract. Have a reasonable detailed scenario of the repairs you're going to do and the cost. If you're new, maybe have 1 or 2 independent contractor bids to support your numbers to show that you've done your due diligence along the way and you're doing the right thing to get that property repaired. That's what your lender is going to look for. Know what the after repaired value is. So you can work off your loan to value properly. Be able to support the dollars you're putting into this property. And guys, the repairs you put in a $100,000 home, if there ever is a $100,000 home left, but let's say a $200,000 home to a $300,000 to a $400,000 to a $500,000 house, the quality and the differences in repair increase as the value of that home increases. You can do a lot of things differently in a lower end home than you can in a higher end home. For instance, you can put Formica countertops in a $200,000 house, but in a $500,000 home or $600,000 home, they're going to be expecting quartz or granite. Just little things like this. Can I use LVP on my floors, or do I need to put hardwoods? Is that engineered hardwoods or is it real hardwoods? What's the difference? What's the quality of my carpeting? What are the quality of my kitchen cabinets, the bathroom cabinets, the tile, etc.? All these make a difference in the value of your home, and your lender wants to know what it is you intend to do. Because if they're good, they're going to look at it through that same lens and work with you. From our perspective at GOAT Funding, we do all of that. Number one, we don't have a down payment requirement. We go off of a hard 70% of after repaired value. Pretty simple. If you've got a deal that is legitimately 70% after repair value, etc., you may have a 100% finance deal. Awesome. If it's not quite that, you bring the difference to the table, whether it's 3%, 5%, or whatever it might be. We're going to look at the repair takeoff that you are providing to us. We're going to evaluate that property and what you plan to do to it to ensure it's being done properly and correctly. And the reason we do that is we want you to be successful in the industry, do this house right, so you can have a quick exit strategy of selling or refinancing that home, So it benefits you, not necessarily us in that instance. Having the right lender is so important. Someone who will support you, help you, provide you contracting leads, other leads, whenever possible, discount leads, things of that nature that are so beneficial along the way. So it's important to know who you're dealing with in the marketplace, know what the terms, conditions are, and go in well armed with the right information that they're going to want to see up front. It'll make your transaction go smoother, easier, and help you procure that very first loan along the way. So guys, I hope you found this video helpful. If you did, take a minute and like it, please. Make any comments below. Happy to get back to you on those. Come see us on our YouTube channel and join us. We look forward to seeing you all next time.